Hi everyone, welcome back to BRH Podcast. I got Arun with me. As always, he's got some questions which need some answers. Let's see if we can get him some answers.
So recently, Moody gave the rating for Tata Motors as BA3. So one viewer has asked about this. So I need to know what is BA3 ratings and does it have to do anything with the demerger announcement which was made by Tata Motors?
Modi is a rating company, right? They give ratings out. But I don't think there's anyone in our group buying bonds or not bonds because this rating is mainly for borrowing money.
Okay.
What is it?
BA3 ratings.
BA3 ratings, yeah. So this comes on the heel of the demerger. So that means Modi is saying it's a good thing. It gives me a positive outlook. So nobody, like people like you and me, don't invest based on Modi, right? Modi's rating is meant for people when they want to borrow money. So if somebody wants to buy a bond of Tata Motors or wants to lend money to Tata Motors, they look at the rating agency if they don't know anything about the company. Fortunately for us, just being in India, we know about Tata Motors, we know about the Tata Group. So these ratings we really don't look at.
So investors need not worry about this?
No.
Okay.
We don't need to worry about this as an Indian investor, I would say. Because as far as Tata Group and Tata Motors is concerned, we know everything about it. Modi's rating is based on other metrics which really does not concern us. This is what I feel. And this also only applies if you're looking at buying Tata Motor bonds. If you're looking at Tata Motor shares, this rating has nothing of value to it. Because you're not going to buy a company's share or invest in a company based on its Modi's rating. You're going to purely base it on the debt it has and the PE ratio and the price and the business model it has and the people who are running it. Because Modi gives a AAA rating or a triple D rating, you're not going to go buy a company share. So you don't have to worry about it.
Okay. So one more person has asked, sir, banks have more debt than market cap. Then how do I invest in it?
First of all, you only look at debt for companies, not banks. Because a bank's debt is what?
It's
who does bank borrow money from?
From the depositors who give their money in the form of savings account.
So what is the bank's business?
It borrows money from the depositors and then lends it to
people who want
other
money.
people.
It makes money in the middle. So if it has debt, it's good. That means a lot of people are depositing money.
That's a good thing for a bank.
The more deposits the bank has, the more solid it is. So don't worry about
that. That means more people trust that bank and deposit their money.
Yes, you can say that. And what you should basically look at a bank is PBI ratio, price to book. Book is the actual money the bank has per share. Because the bank has nothing but that. It doesn't have any factories, it doesn't have any other assets other than this. Whatever is there on the bank's book. So book value, if you look price to book, if it's less than 1, the price of the share is at a good price. It is at a reasonable price. You can look at buying it. If it's above 1, that means it's starting to get overpriced and you should not really think about investing in it unless you have no other option. So if you see banks like HDFC and ICICI, they're like 4 times, 5 times book. That's why Anand always says consider a Karnataka bank because it's below 1. And when it starts crossing 1, Anand will also say maybe you can look at some other bank. So for a bank, if you're planning to invest in a bank, what you should look and focus on is the price to book.
So this is a lengthy question. Hi sir, I have a question with inflation and bank loan interest rate. Average inflation rate is 6% and SBI home loan lending is 8.4% nominal. So real interest rate is 2.4%. But we understand that world inflation rate is always high than reported. So it should be around 8%. Does that mean that banks are lending at a loss?
No.
This is okay, that's it.
No. I'll explain it. Okay, bank borrowing cost is what? Bank borrows from 2 sources. One is the RBI or it can borrow from depositors. Depositors is always the first choice to borrow from. Okay, because borrowing from depositors is cheap and it can fluctuate. Meaning the interest rate we pay the depositors, he can move it up and down. Right now, bank savings account depositors getting 4 or 5%. Some banks will say 6%. Right, and that means he's giving you 4%. Then he's lending it for 8%. There itself is making a 4% spread. Now you're only looking at home loan. Home loans are loans that run for 20 years. Okay.
So 20 years guaranteed income for the bank.
Correct, for the bank. So that's different. It's secured also. It has a house attached to it. It's secured loan and it's long-term money coming and it's locked in. While if you look at it in short-term loans, they don't give 8%. Car loans are higher, right? And unsecured personal loans can become 12%, 14%. So that banks are making a killing. Then if you leave this and get into credit cards, what they're doing in
that's
credit
more
cards,
than 20%.
Yeah. So they're making money everywhere. right? And aside from this, they do business loans. They do lend money to companies. They're all structured at different rates. So they're making a lot of money. So to just think banks are doing home loans and they're making a loss on home loans is the wrong way to look at it.
And we shouldn't look at inflation rate versus bank lending rate also.
Nothing. It's got nothing to do with each other. Inflation rate affects us more than the bank. For a bank, as soon as the RBI increases the rate, he starts increasing loan rate. And of course, he also increases savings account rates also go up. But that's very marginal compared to how fast the interest rate goes up in the loans.
Okay.
Same way when RBI cuts rates, banks usually will follow in tandem and they'll also cut their lending rates. But that will always be slow if you notice. RBI will reduce
the prime factor which determines the bank lending rate is the RBI repo rate and reverse repo rate.
Yeah.
Okay.
Because they keep in tandem with it. Because RBI is also mandated and RBI governs all these things. Otherwise, if there's no governance like what is happening in NBFCs where RBI said you do whatever you want, you find extraordinary interest rates. You know, the guy looks at you and he charges interest rate. He can even charge you 18%, 19%, 20%, whatever he feels like. RBI has removed that mandate over there. All they did is recently give a warning saying, don't do this.
Okay.
RBI can step inside and start mandating that also. They decided right now not to because I explained also. NBFCs usually carry the burden of lending to people who are not usually in the regular stream for availing loans. That means they don't have proper income proof or they have a bad track record. They're not able to secure the loans. So for those people who banks reject, there's no other option but to go to NBFCs. And usually in those categories, there's high failure rate.
Okay.
There's a lot of NPS in that. So they have to factor in the cost of NPS. So of course, interest rate has to be higher. They don't have a choice. We have answered some questions for you guys on the podcast today. We kept it short and brief instead of rambling on and on, which I usually do. I think some of you might be thankful for that Vinod kept it short and brief today and didn't bore you to death. Anyway, thanks for watching the podcast, guys, and we'll see you in the next one soon. Bye.
Thank you.